Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options. Thank you all for joining us. Today's webinar is going to be with Headley, and he's going to be educating us on how to trade the big trends in the FX market using FX options. Headley was inducted into the Traders Hall of Fame in 2007 and is the founder of BigTrends.com. BigTrends.com provides investors with specific real-time stock and option strategies and investment education to profit from significant market trends. So right now we're just going to turn it on over to Price for our presentation. Thanks, Price.
Hey, well, thank you very much. It's great to be with everybody today, and definitely excited to really focus in on some of the tools that I use at Big Trends and turning some of these indicators into tools you can use for trading the FX options at the ISE. Everything that we focus on here, of course, is geared for your education and information only. You should consider all this as a starting point in your continuing education because it really is a process. I've been trading for 21 years, and I really always feel like I still want to be green and growing, always learning something from the markets here. So we're going to talk about trading the big trends using FX options today, and encourage you to chime in with any questions via the chat Q&A box. You can feel free to let us know anything that's on your mind there. So let's go ahead and get started here. And of course, everything that's here is geared as just examples. It should not be considered any kind of specific buy or sell on any particular chart shown. And of course, options involve risk and are not suitable for everyone. We encourage you to really read over the characteristics and risks of standardized options, and you can get more information on that through the information shown on this slide here. Now, the biggest thing that I'm a big fan of is taking sole responsibility for your investment decisions. You know that that's your sole responsibility anyway, so bottom line is by taking that accountability, you're positioning yourself to be a lot more effective in whatever trading strategy you choose to use. Now, about the ISE's FX options, it's really been made very accessible through your options broker. These are exchange-listed securities that are cash settled in U.S. dollars. When we talk about exercise, it's a European-style exercise, meaning European is focused on just at the expiration only is the only time that you can see an exercise. Of course, you can exit beforehand, and that's what I tend to do before we even get to an expiration date. And of course, we can also, you see these traded as spread. So everything's quoted in, per U.S. dollar. So you've got the Aussie dollar, the British pound, Canadian dollar, euro. The yen is one of my favorites. The yuck is my favorite symbol, I think, of all time, the YUK. Actually, I'm going to show you an updated chart of that a little bit later as it relates to what's been happening with the Japan crisis and the volatility in that market. So you obviously, as option traders, you're geared at wanting to take advantage of trends and take advantage of volatility. So we'll talk about that here today. But the big trends approach, our mottos and know your options, founded it back in '99. My goal was to take both some proprietary techniques I developed as well as some tweaks and little twists on existing techniques to be more effective in trend following on both up and down markets. I've trained a variety of our analysts as coaches, and so we've done a lot more in the education space, probably in the last 5 or 6 years compared to the first 5 that were mainly just making specific newsletter recommendations. So we really have a broad range of educational options and geared at really helping profit from any kind of a market environment. I think that everybody wants consistency. Everybody wants to see something where they can really zero in, get improvements in their accuracy rate, improvements in their overall portfolio equity growth, and also managing the risk accordingly. And so certainly we all know that, you want to be profitable over time, and, at the same time you must if you're a higher risk or lower risk trader, you must be constantly managing your equity curve. And so for me, the way that I do that is by the technical analysis, the charts, really looking at what is the chart telling me, because that's really showing you how you can focus on which direction is the market headed in. There's the old quote from the famed trader Jesse Livermore in the classic book Reminiscences of a Stock Operator, where Livermore is said to be saying that there was really no bull side or bear side. There's only one side, and that's the right side. And the idea is that your job is to be an unbiased observer first and foremost of what the market is telling you. Is it telling you that we're ready to go up, ready to go down, continue to go up or down, or they're ready for a turn, a change, or that there's no action yet to be taken? That's also another alternative. So these are things that you need to be able to identify, and for us, the trend analysis is the way that we identify these opportunities to be more accurate in our decision. So really you're listening to the market. RW asks specifically how we hedge a stock portfolio against dollar currency risk. He's saying especially against a hedge against a sudden price shock. And so we'll talk about that as it relates to some of these charts, because one of the things, since we're comparing these FX options vehicles, all these other foreign currencies against the dollar, you can actually see from the charts, RW and others, how which currency is the strongest against the dollar, which currency is the weakest against the dollar. So how you might want to even create some positions to benefit on both sides of that. But you certainly that you can do that kind of hedging against if you're worried about your U.S. stock portfolio basically losing value with perhaps a weaker dollar. You can see which of these other foreign currencies is a relatively better place to be, and then get some positions, some call positions, for example, in some of these other foreign vehicles that are going up while the dollar's going down. So we always look at, okay, how do we define the trend? We'll talk about that today. And then how do you manage the trade once you're in the trend? So that's where the consistency is developed over time of saying, okay, when do you get in and when do you get out? It's easy to get in, and it's hard to get out if you don't know specifically what your exit points are along the way of a trend. So it's very, very important that you define those, and that's where, again, the technicals tell us exactly at what chart points we need to say bye-bye on a trade. So we don't want to ever have to worry and say, what do we do now? What do we do next? That type of feeling stuck in a trade, I think, is one of the more frustrating feelings for traders, of just feeling like you're kind of floating out there and not sure what's the next action. So we're always saying, what's our next action? Is it buy, sell, or hold? We've got to know every point of a trade what we're doing in that trade, what our next intention is, where we'll take some profits off the table, where we'll take our loss, or where we'll trail that stop so it'll eventually take us out of a trend when the trend loses gas. So, this pyramid, if you will, the bulk of traders obviously come in at the bottom of the pyramid, not having a plan, newer to the markets, not really knowing that it's not as easy as it looks. I think everybody who's here that's traded for a while can say that, yeah, it's a process. You don't expect that you're going to win on every trade. You expect that you have to manage yourself and your trades better to get more out of all of your trades over time. As you gain experience, from those initial traders that take the small gain because they're so happy to just get any gain, and then they don't want to take a loss, so they let their small loss turn into a large loss. Obviously, that's not a secret for success. As you get more experience, you start to know more about trading. You still kind of having some hits or misses, and then as you gain the education of the right kind of education, you can have all kinds of people telling you all kinds of things. The question is it the right kind of education to ultimately sets you in for the process of taking quick losses and letting your winners run? That's what everything the big trends approach is geared to do, is educating you on turning around that natural human behavior pattern to not want to take a loss and say, hey, if it's not working quickly, get that money back and let's move it into something else that's got a better chance to work. And so we call this smart trading, looking for more consistent strategies. So with options, like when we talk about the FX options, one of my favorite strategies is the in-the-money options buy. So meaning that, if you've got an FX vehicle, we'll talk about some of them here, that's trading at at 60, we're not going to buy the 60 calls right at the money. We're going to tend to buy the several points in the money where right away it's got a meaningful majority portion of the option's total value is what we call intrinsic value. So we'll talk about that. And usually we want to buy some more time. We want to give ourselves room for a move to play out, but we also want to know that if we expect the move is going to take a month, don't buy a 1-month option. Buy something at least another month out, so you have some time left after your expected holding period is over, so that regardless of what happens, even if it didn't move, you're not seeing, the same kind of decay risk that you would for people that are trying to ride the rails and play it super aggressive. We tend to be more conservative, but I find being more conservative is still, in options, it's still a relatively better thing than if you were just buying the underlying vehicle. And yet it's a more sane way to trade. It'll keep you a lot more emotionally and financially stable in our experience. But you want to trade the trending securities, though, really to maximize your profits. The idea here is that opportunity cost is always with every one of us as traders and investors. So you buy something and it goes up 10%. Well, something else in the same holding period went up 30%. Well, then you've left, that 20 percentage point difference on the table as an opportunity lost. So from this perspective, we really want to make sure that we're trading the best of the best trends. And there's times where you don't want to trade. There's times where if you don't have an edge, you shouldn't be sitting at the table. The reality is that when you have an edge, that's when you want to take advantage of it over time. And at the same time, you want to apply consistent money management rules so that you're not loading the boat on any one trade. You're giving yourself a chance to, over time, take money out of the market when you have a positive edge. So that's why we like the FX options, because they really fit these criteria. In fact, what I love about FX in general is that you'll see from the charts, they really give us some very consistent trends up and down. That's what we're really looking for, is that consistency and persistence of trends. So the idea here is that with all these currencies, of course, we all know what's going on with the massive, $14 trillion U.S. deficits, and then also a situation in which we say, okay, there's let's see, make sure our audio is coming through here. There's plenty of opportunity with what's going on with governments really working kind of frankly against the currencies, because hey, what's the incentive to appreciate a currency when they're going to have to pay back these dollars down the road? I'll steer clear of conspiracy theory and say let the market and the chart tell you what's going on, and say how do you then hedge accordingly, per RW's question earlier, saying protecting your current assets, and this is a great way to do it with these FX options. So the beauty of this too is that you don't have to set up a separate Forex account to trade these vehicles. These FX options can be traded just like your other securities accounts, your other options accounts. So it makes it real simple. And then when you talk about correlation, we're talking about, okay, how much does a currency move in the same direction as the market or in a different direction? Typically, if you're building a diversified portfolio, you want less correlated assets in your portfolio. So we've seen relatively low correlation in the currencies compared to how stocks move. And then we see these long trends that last a lot longer than you would expect. And that's what I love to see, when you see trends that get in place and then they last and they last. And then you keep thinking the trend's got to change, but the indicator says, no, stay with it. That's where the best opportunity is. One of the other aspects is, if you're trading stock options, there's over 3,000 optionable stocks. Well, with the FX options, we're really dealing with just a couple of handfuls, so really kind of 8 core focused positions that we would tend to say, you should really zero in on. So you've got the U.S. dollar, of course, the euro, the yen, you've got the pound, the franc, in this case the Swiss franc, and we're talking about then the Canadian dollar and Australian dollar as well, and the New Zealand dollar. So those are the key ones that we've looked at. And I know I've in past webinars shown examples where even the Canadian dollar versus the U.S. dollar doesn't sound like it would be that much different. It's just across the border, and yet there's huge differences in the way that those different types of dollars, U.S. versus Canadian, move, and those have been some of our biggest and most successful calls in the past. So just something to keep in mind, that just because you see a Canadian or an Australian dollar, it's not it's not so correlated with U.S. dollar, and you're going to see big trends up and down. So we're a big advocate of, you want to always be getting smarter. It's the old, you don't want to work harder, you want to work smarter. And it's the same thing with trading. You don't want to trade harder or more necessarily. You just want to trade smarter and with the vehicles you choose. Now, in this case, we show the old smart car vehicle. For me, actually, I drive an SUV because I don't feel like being in an auto accident in a smart car. But of course, from why were these developed? They're intelligent. In '09, they're more efficient. Not using as much gas. More understanding, thought, and judgment. Again, this is personal preferences. So not just smart cars, but we've also got smart energy coming out with all kinds of other approaches. Of course, now nuclear is going to be under the microscope for a while here, but also smart goals. And Stefan says he does have a smart car. I hope you enjoy it. It's pretty cool looking. Just don't want to just want you to be safe. And then of course. The best indicator for me, and what I'm going to share with you today, has been using some modifications on Larry Williams' %R, percent range indicator, because it really helps. And so Stefan says he gets a 5-star insurance rating because of his smart car, so I'm glad to hear that. Excellent. So safety first. All right. So, let's go into the rules, because I know you're probably eager to look at some charts, and I want to share some charts with you as well. So as we look at the bull side, we say, okay, what's my %R bull setup? And what does %R mean, first of all? Percent range is what this means to be looking at effectively a percentage range from 0 to 100%. So we all think in percentiles going back to grade school, and the reality is that, if you were in the top 10%, you're getting an A. Well, in this case, that would be, okay, so you get a 90% reading. You're in the top 10% of all the recent highs for that particular percent range indicator. So we want it to go overbought. We actually, for a bullish setup, I want to see it go overbought. This is where, you have to kind of initially take a leap of faith until you see this yourself. And the reason is because I did this based on data testing, to say, okay, what happens to these situations that go overbought? Is it better to sell them or is it better to buy them? And surprisingly, over time, there was a very clear bias in my testing, especially across the U.S. equities market, but I've seen it work well in the foreign exchange market too, that, these trends, when they go overbought and then this very specific pattern develops, it tells you that institutions are actually acquiring more of this security. They want more of it. They're not selling it. They're trying to buy it still. And that's the thought, is that you're looking for those kind of sustainable trends that you can really get on board. So we want it to go overbought. For us, it's in the top 20% of reading. So on a 0 to plus 100 scale, something above that 80 percentile. And so once we get that confirmation point, the confirmation for me is where we actually see a close, and that's the key word on this chart, a close above that first overbought setup bars high. We call that the setup when it first goes overbought. And preferably the sooner the better. I give it 5 bars. If we're looking at a daily chart, that's 5 days. We're not talking about pubs. We're talking about intervals of time. That's 5 bars, 5 candles, whatever kind of a chart you look at. Now, if you're using an hourly chart, that would be the next 5 hours. So, whichever time frame you use, the testing says that should happen fairly quickly to tell you that there's the demand for this, that people want on board. That's the whole goal of this type of an approach. That's the confirmation that you now have something unusual happening. And then once you're in that kind of a strong bull trend, we have techniques that we use called the retest method, which means that once we're already bull confirmed, then when it comes back underneath that 80 threshold, in this case 79.5 or less, initially I used to worry, okay, it's coming out of the overbought mode, that's a problem. And in fact, that becomes a key retest point. Something is going to give. Either it's going to be a great chance to set our stops to say that low should not be violated. It should not close below that low. If it does, that's the end of the uptrend. So at the same time, the beauty of these retests is that if you miss the first leg of a move, this is a great spot, in my experience, to get back on board for the next leg of the move. So the idea is that it's relatively a low-risk area where if we're wrong, we can stop the trade out quickly If we're right, we can basically get a great entry point within a still developing trend. So I call this my low-risk entry point off of the retest to either start a position or build onto an existing one. Okay, now for bearish side, we've got the other side of the equation. So bear setup, we're actually looking for the bottom 20% of readings below the 20 threshold. So we go below that 20 threshold, we say, okay, that's a possibility that it could be bearish. It doesn't mean it's bearish right away. It means that we're now at the bottom of a potential trading range. Can it break through the bottom of that range and tell you it's ready to trend to the downside? So the bear confirmation is once you get that setup, bars low in place, you say, okay, that setup bars lows in place. What happens? What happens after that? So this is what we're looking for is, okay, what happens next? If we indeed break that low and continue to drop, then you have a situation in which you have a market that really, is probably headed a lot lower. We saw this with the financial crisis in 07, 08. And so the big word here is close. Must close. You can't try to front run it and try to bet that it's going to break down before it actually does, because you'll get faked out too much of the time where it tries to go below there, you jump in, and then it flips back up. So we really want to get that confirmation first and foremost. So from that point, once we're in the bear trade, we can say, okay, now where's a place to potentially reset our stops? The next move over the 20 threshold, 20.5 or higher, tells us that that's our new closing stop. Now, that's a different word than a lot of you may have heard of. The closing stop means that we're looking at if it closes above that bar's high, because that bar's high is a key threshold. It'll test that a number of times, but then a lot of times it'll close back underneath it. So this is very useful for us as now a bearish low-risk entry point or a low-risk adding point where we can say, okay, we know it's a crunch time point. I call this an inflection point. It's like something's got to give. Either it's going to move on up through there and we're going to get stopped out of the remaining bear trade, or it's going to keep on trending down and you get a great chance to get back on board for the next wave.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.